I happen not to believe that, unlike Europe, which is already at a 7-day average of around 330,000 cases, I don't think that the wave we'll see, and we will undoubtedly see one, I don't think it'll be more impactful than the wave we saw in late August, around 150,000 cases. Now, that doesn't mean that I won't be wrong, and we'll see after Thanksgiving if those numbers are accelerating, but it also doesn't mean that there's not a psychological effect. And so I think we saw that last week with the Finergy trade going the other way, which might be right for energy, particularly if we have demand destruction in Europe with further closures, but it's probably not right with financials. I don't see that we're pushing off a more positive net interest margin environment for next year. But again, if you think the wave is going to be more intense, you're going to want to stay away from those sectors that will be impacted with further closures and mandates, as well as stay away from those sectors that will be most impacted by the continued inflationary pressures. And so I'm staying away from things like hotels and airlines and travel-associated things until I get more clarity on that. And my flight to safety is based on software, which has tremendous growth potential, tremendous margin protection. We saw some blowout quarters. We saw growth drivers. We saw margin expansion at Adobe and Microsoft and Google. And so, yes, I'm being very selective. I'm being cautious until we get past Thanksgiving, until I can verify that this wave won't be more impactful than I thought.
So, Sylvia, would you, some of those sectors that Greg is avoiding, if you did see some weakness there, do you think it's time to add to positions there? Or are you're long, but you're also selectively long, maybe areas that could benefit either way?
Good morning, Joe. Great question. I'm actually gobbling up, pun intended, the travel stocks. In 2020, the travel industry lost about $4.9 trillion in revenues. And I think that, the recent setback with Austria going on lockdown, Netherlands talking about it, Germany talking about it, poses some opportunities to get back into international airlines. These are some of the names that are still off of 52-week highs. And I think as we fully reopen and we get past this next wave of COVID, you're going to see some opportunity to pop there. So I would definitely go into those names. And if you look back at the COVID spikes, pretty much all of these sectors that pulled back ended up rebounding and becoming good buying opportunities. But I also agree that, sticking with some of the high margin names like the Microsofts and the tech names is really good. I think, it plays out well for the flexible work from home situation. But these are also the names of the future. We're talking about Web 3.0, and I think the semiconductors, the Microsofts of the world, the high octane tech companies are going to benefit from that too. So you have sort of two good factors playing in for those names.
So, Greg, if there is fears of another wave, that might keep the Fed once again at least very slow to change policy. So that could end up being a silver lining too.
A silver lining for some. And so, again, it all depends on how acute you think the wave will be. We saw very little change in behavior. We saw very little change in trends when we had that wave in late August. And so I don't think, as long as we don't surpass that it would have the Fed reconsider what its schedule is like in terms of tightening. In fact, exactly. And so, and if they postpone that schedule, it would certainly not be great for financials, because we're looking forward to that more positive net interest margin environment in 2022 that we did not see in 2021. Those that had banking and capital markets saw growth based on that. But I'm looking for a more positive net interest margin that should lift the sector next year.
Okay. All right, Greg Branch, Sylvia Jablonski, thank you both.